5 years ago, I started investing. I opened a Roth IRA, I started buying a couple funds, and now I'm on my way to becoming a millionaire with very little effort. And to just give you full context, my wife also has a 401k, a Roth IRA, and we invest into an individual brokerage account. So with all things considered, we'll probably hit that millionaire status in less than 30 years. But before I get too ahead of myself, my name is JC. I do want to share with you the couple funds I did start buying 5 years ago, but there are just a few prerequisites that you need to achieve before you even consider investing. I want investing to feel like an energizing experience rather than a stressful worry because you didn't have a couple things set up first. One, you need a full emergency fund. An emergency fund can start off with just a couple $1,000s, but if you can get cash that can cover up to 3 to 6 months of your living expenses, then you'll be home free. You'll be golden, and you'll be able to start investing with very little stress and a lot of financial peace. Like, imagine what would happen if you started investing too early without any emergency cash savings. Your car breaks down or you might lose your job, so where are you gonna go for some extra cash? If you try to pull from your investments, then you're gonna get penalized, and if you use credit cards, you're just gonna get deeper into debt. When I started investing, I was still single, but I had $10,000 saved up, and that was a good cushion for me to start investing without any worries. The second prerequisite that I followed before I started investing was to be completely debt-free. And in this case, I would just really prioritize the high interest debt, like credit cards or personal loans, because literally, what is the point of investing and earning 10 or 11% gains on your mutual or index fund when you're still having to pay this credit card that's growing by 23%? It would be a much better return on your money if you threw cash at that credit card debt versus trying to invest at the same time, because one, you're going to slow your progress down, and two, you'll be losing more money than gaining. If you have a low interest debt like a student loan or a low interest car loan, and of course a mortgage, then it's not quite so urgent. But if I were you, I would just pay the student loan and the car debt off if that's reasonable. You can comment below and I'll reply to you to see what better fits for your situation. But at this point, if you've taken care of those two things, you are ready to start investing. There is just one thing though. You do not want to invest the way I was taught. The first time I was introduced to the world of investing, I was in college, and it was some business finance class. And they gave us like $1,000 of hypothetical money that we can put into the stock market. And we had a challenge. We had to pick 5 stocks from 5 different companies. And at the end of the semester, we would see whose portfolio did the best. Now, as a 20-year-old, I had no idea what was a good company to invest in. I was just like, Apple. I have an iPhone, so they're probably doing well. Ultimately, our portfolios all pretty much sucked at the end of the semester, and I chose not to do this again. It actually kind of scared me from the world of investing because it all seemed like a big risk because I had no idea how this was going to perform in just a span of 4 months. And honestly, looking back, I hope no other student took that semester and thought like, this is how investing is going to be. Because if it feels that way, then it definitely feels like a big old gamble with a lot of risk. And that's why I want to share with you my 3 guiding principles when it comes to investing today. 1. Pre-diversified investments. And when I use the term pre-diversified, that's not an actual finance term, but it describes what I invest into, which are index funds and mutual funds. Ultimately, if you are investing into a fund, you are buying multiple stocks from multiple companies. If you look at it like this pen cup on my desk, this whole box is a fund, and these pens can represent individual company stock. Like this might be Apple, this one might be Nvidia, but you're buying 8 of them all at once. So if you're thinking of a real life investment like a Fidelity 500 index fund, that's going to consist of one of these and 500 pens, so 500 different companies you are investing into at the same time. And that doesn't mean you have to be a billionaire to buy 500 different company stocks. You're actually just buying 500 pieces of different company stocks. Does that help? So if you can't tell, I love index funds, but I also really love mutual funds. There are a few select ones that perform better than these index funds, and there's a couple reasons why. One, these mutual funds can be more specific to a certain industry than an index fund. An index fund will just follow something like the S&P 500, which are the top 500 companies in the US, from technology to utilities to financial companies. But you can get a mutual fund that maybe relies on the fastest growing stocks or the top 300 tech companies or whatever. And sometimes those are a little more risky, but perform better than an index fund. You just have to look through a couple things like the history of the fund managers and the expense ratios, because you don't want to get screwed there. I don't want to bore you with all the jargon or start an argument in the comments here, because ultimately, if you're investing into funds, you're doing better than most investors who are just trying to buy individual stocks. 2, get into investing and don't get into speculating. I'm gonna be honest with you guys, I have zero cryptocurrency in my portfolio, and I know it's becoming more legit, and with the new administration, it's becoming more legit, but still, I don't own any piece of Bitcoin or Ethereum. I could have a portion of that in my portfolio, but I just really turn away from most alternative investments. And yes, that is exactly why I am really boring to talk to in a financial conversation, because I have no idea what's going on in the crypto world or what's happening with gold or REITs. Like, I'm a pretty lame finance bro. But when I buy an index fund, this consists of companies. These are real businesses full of people who are working towards growing the wealth of the business because they're serving some kind of product or selling some kind of service. When I'm speculating and buying a piece of crypto or gold, I'm not looking at an entity that's trying to grow wealth. I'm just waiting on that thing to change in price. And if my future and my retirement relies on the changing price of some commodity, then I'm gonna be stressed out. I remember when I used to work in office, my coworkers were all into these alternative investments like gold and crypto, or even involved in things like puts and short selling. And every day, it just felt like they had a different mood depending on how the market was doing that day. I don't need that stress in my life. I have a whole lot more to stress about. Principle 3, invest for your timeline. There is so much content out there about investing. There are those long-term TV shows that always play out what's happening in the market that day. But who is that content made for? Most of the time, that content is made for day traders and people who care about the daily, weekly, and monthly returns in the stock market. If you have a timeline that's supposed to extend for the next 30 years, does the weekly playout of the market really affect your long-term goals? Probably not. Like last month when the whole tariff situation happened and things were dropping in price like crazy, I'm young, right? My perspective is that I have literally 30 plus years to sit in the stock market, and I know the trend of the stock market always goes up, even after these dips. So I wasn't worried or stressed or selling off things in order to try to beat the market. But let's take a look at someone that's older and maybe they're closer to retirement. They have a whole different strategy than me. You'd probably want a more balanced portfolio, one that just doesn't rely on stocks, but maybe now some bonds. Like, I'm grateful for the privilege to be optimistic about the future because the future is a lot longer to me than it is for a 57-year-old. I've seen way too many people get pressured by other people making investing choices that have different goals than them. Like, I have a lot of friends in this finance space who care about short-term market plays because they also want to make some passive income today, right here and right now with their individual stocks. For me, I'm not going to get pressured by them if they start selling, for me to start selling, because my goals are different from their current goals. So just drown out the noise and do what you need to do to stay invested. I'll be honest with you guys too, like, I understand nowadays how some people just need to buy a little bit of crypto or a little bit of some individual stock that's blowing up right now in order to just scratch the itch. You know, people just have this feeling of FOMO where they need to feel involved. And if that's what it takes to just invest a couple $100s into crypto or a couple hundred into this company that's doing really well in order for you to stay in the market, then let it be. Like, just do that so that you stay motivated and it keeps investing fun for you. But just make sure the majority of your investing money is going into those long-term investments that actually lead to your ultimate goals. All right, here's the fun part. I'm gonna reveal now the 2 funds that I have invested into since I first opened my Roth IRA. It's actually very boring. And before I reveal it, make sure you like this video if you've enjoyed what I've shared so far. But here it goes, okay? FBGRX, it's the Fidelity Blue Chip Growth Fund, and FXAIX, which is the Fidelity 500 Index Fund. Two-fund portfolio. Think of my individual account. I bought a couple of individual stocks when I didn't know what I was doing, and they're just still sitting there. I think it's like JetBlue and Meta, and they're both doing garbage right now, but majority of my investments are in FBGRX and FXAIX. And I know a lot of people will be like, JC, why are you in a mutual fund? Those expense ratios are robbing you of your wealth. Well, yeah, it's true. The expense ratios are taking away some of my returns. Like FBGRX has an average expense ratio of 0.79%, and FXAIX has an expense ratio of only 0.01%. But if you look at their 10-year average annual returns, we got over 15% for the Blue Chip Growth Fund and around 12% for the 500 Index Fund. So that more drastic difference is offsetting that expense ratio. And of course, we could argue about this all day, but heck, as long as we're both investing right, we're chilling. And I'm younger right now, like FBGRX might be a little more volatile, might be more risky, but let's realize again, we're both investing into something that's very diversified, and who knows, maybe I'll rebalance and invest more into the 500 Index Fund if I realize I'm an idiot. So there you go, guys. Ultimately, my wife and I would be investing more of our money, but right now we have a goal of saving for a house. So a lot of our money is being allocated to a down payment fund, but still, we're still maxing out our Roth IRA. She's still putting 15% into a 401k, but make sure to subscribe and click this video if you want to learn some of the frugal habits that have allowed us to free up so much money to be able to hit these goals, like investing for our future and saving for a house at the same time. Give it a click, and I'll see you guys over there.